Here are two charts, same time period, October 2025 through today. On the right one, we have gold up 24%, records high, central banks buying at the fastest pace in recorded history. And on the left one, we have Bitcoin down 44%, spot ETF outflows in the billions, futures open interest cuts in half. It's the same macro environment, it's the same Fed, the same inflation, same geopolitical backdrop, but completely opposite outcomes. So every week I see the same question across trading forums, Twitter, YouTube comments. Why is gold going up and while Bitcoin is going down? Aren't they supposed to do the same thing? No, they are not. And the reason they are not has nothing to do with technicals, nothing to do with sentiment, and nothing to do with any prediction about where either asset is heading next. It has to do with the theory from 1730 that most traders have never heard of. And it explains not just gold and Bitcoin, but everything that happened in market this week. My name is Jesper, and this is the Institutional Volume Terminal. Institutional volume analysis across equities, metals, forex, and crypto. And today I'm going to show you the framework that changed how I read markets permanently. Just a quick history lesson here. In 1730, an Irish-French economist named Richard Cantillon, he published an essay that made one observation nobody had clearly articulated before. When new money enters the economy, whether a king is minting coins or a central bank is cutting rates, it doesn't reach everyone at the same time. It flows through a sequence. The people and institutions closest to the source of new money, they benefit first. Those furthest away, they benefit last. And some never benefit at all. This isn't controversial, it's mechanical. If the Reserve cuts interest rates, the first people to access the cheaper capital are banks and financial institutions. They deploy it into the most liquid, safest assets first. Bonds, treasuries. Then it flows into large cap equities. Then conditions persists. It rotates into riskier assets, small caps, high yield credit, and crypto. So the key insight and the reason I name my entire framework and practice after this is that the sequence is predictable, even when the direction isn't. You don't need to predict whether the Fed will cut or hold. You need to identify where we are in the flow sequence, because that tells you which asset are receiving institutional money right now and which are being starved on it. I've codified this into 5 regime states that I track daily across 3 layers. It's liquidity, conditions, equity market structure, and risk asset behavior. The combination tells me and tells anyone using the framework exactly where institutional money is flowing in real time. And what it's been telling us this week is a story that makes perfect sense once you see it. On Monday, my Cantillon flow indicator was reading early cycle across every instrument I track. So what does early cycle mean? Liquidity is bullish, the bond market is bid, the monetary conditions from last year rate cuts are still flowing through the system. Equities are bullish, the S&P was holding above the institutional cost basis. But risk assets, crypto specifically, were bearish. Early cycle tells you money is flowing, but it hasn't reached the end of the chain yet. The practical implication: buy dips in equities and gold. Avoid crypto. That was Monday. By Thursday, right after the S&P dropped 1.5%, the Nasdaq 2%, and Apple had its worst session since April, The reading shifted to accumulation. Liquidity is still bullish, but equities flipped to bearish, and risk assets remain bearish. Now here's where this gets really instructive. Thursday's sell-off looked like chaos on the surface. AI stocks getting destroyed, software ETFs down 2.7%, Cisco collapsing 12% on guidance that showed rising input cost. Bitcoin continued to bleed. But if you tracked what happened beneath the price action, it was completely orderly. Bonds caught a bit. That's the Cantillon sequence working. Assets closest to the monetary source absorb flows first, doing stress. Bonds caught a bit. That's the Cantillon sequence working. Assets closest to the monetary source absorb flows first, doing stress. Within equities, the rotation was surgical. Walmart gained 3.8%. McDonald's rose 2.7% on earnings. Cash flow rich, defensive businesses with pricing power. Institutional money didn't leave the market. It moved within the market. From assets that depend on future liquidity expansions to assets that generate cash today. Gold and silver sold off, which confused a lot of people. If gold is the Cantillon beneficiary, why did it go down? Well, because of margin mechanics. When equity portfolios drop 1.5% in a single session, margin calls cascade across multi-asset books. Fund managers are forced to sell their winners to fund their losers. Gold was a winner, and this is critical. The volume structure didn't break. The institutional cost basis levels held, as you see here. The value area absorbed the selling. This is what I call deleveraging, not distribution. Deleveraging is mechanical and temporary. Distribution is institutional and structural. The chart tells you which one it is. And then there's Bitcoin, down to 66,000. Perpetual futures open interest down 51% from October peak. Spot ETF outflows of 3 billion in January alone, after 7 billion in November and 2 billion in December. Look at the volume profile. There's a massive cluster of institutional between 88 and 93. That was the cost basis. And then there's almost nothing between 70 and 85. An air pocket. No institutional positions were built in that zone. Price fell through it with no resistance. Bitcoin sits at the very end of the Cantillon flow sequence. It's the last asset to receive institutional money during an expansion and the first to lose it during a contraction. That's not a prediction, that's the framework identifying the regime. So here we have an actual chart that shows how the Cantillon terminal reads this in real time. This is Bitcoin on a 4-hour time frame running the full elite indicator. And the dashboard here in the top right corner is telling a story that most traders would completely misread. So let's go through it line by line. Bias, it's bearish. No ambiguity there. But look at the number next to it. Confidence score is 8. That's out of possible 10. Near maximum institutional conviction. Now, most people, they hear bearish with high conviction and think that means short it aggressively. But that's not what an 8 means. The confidence score measures how many institutional volume factors are aligned at the current level. A score of 8 at the lows of a move combined with the other readings on the dashboard tells you something very different from an 8 of the highs. Think of it this way. If you see a conference room full of institutional traders all focused on the same price level, that's high confidence score. It doesn't tell you what they decided to do. It tells you that this level matters. Something significant is happening here. And when 8 out of 10 factors are firing simultaneously at the bottom of a 47% decline, that's determining, telling you this level is where the regime gets resolved one way or another. Then we can look at the VWAP deviation. It's negative 8.4%. Price is sitting nearly 8.4% below the volume weighted average price. The puck is the point of control. It's now at 89,197. That's the price level where the most institutional volume has transacted. That's the cost basis. And Bitcoin at 66,000 is almost 23,000 below it. So here's what that distance means in practice. Every institution that built a position doing consolidation between 85 and 93, and the volume profile that shows that's where the heavy transactional activity was, those positions are deeply underwater. 8.4% underwater on average. Some are worse. When institutional positions are that far underwater, one of two things happen. Either they cut their losses, which create distribution and further downside, or they've already cut, which means there's no institutional bid between the current price and the cost basis. Either scenario is bearish for rally attempts into the 80 to the 90 zone. There's either active selling up there, or there's an air pocket with nobody home. So if we look at the swing type here, the dominant swing structure is confirmed bearish, and it's been running for 170 bars on the 4-hour chart. That's roughly 29 days of continuous bearish structure. This isn't a one-day dip. This is mature, established institutional trend. The swing age matters because the longer a regime persists, the more institutional positioning has been built around it. Short sellers have established positions, hedging strategies are in place, algorithmic trend followers are aligned with the direction. Unwinding all of that requires a catalyst significant enough to force repositioning, not just a relief bounce. If we go and look at the volume compression, it's coiled at 87%. This is critical. When the terminal shows a coiled reading at this level, it means volatility has contracted significantly within the bearish trend. Price is consolidating, energy is building, and at 87%, the spring is nearly loaded. A coiled spring doesn't tell you direction, it tells you the magnitude. The next move out of this compression is going to be significant. But combined with the bearish bias, the 176 bar swing H, and the minus 8.5% to VWAP deviation, the probability favors the downside resolution, not a certainty, but it's a probability. The distinction matters. The divergent grade, it reads moderate. That means selling pressure is fading at these levels. Sellers are becoming less aggressive, but it hasn't reached the extreme grade that typically precedes a reversal. And now the most interesting feature on this chart. See those green labels stacked on top of each other near the current price? Those are strong divergence signals. 3 of them at the same level. A strong divergence means price is making newer lows or testing prior lows, but the underlying volume momentum isn't confirming. Sellers are pushing price down, but the volume behind those pushes is diminishing. So 1 strong divergence is notable. 2 gets you attention, and 3 at the same level is the terminal screaming at you that seller exhaustion is reaching a critical point. But I cannot stress this enough. Divergence is a necessary condition for a bottom. It is not a sufficient one. Divergence can persist for weeks while price continues to grind lower. What you need to see in addition to divergence is the AVAP regime flipping. The bias shifting from bearish to bullish. The volume profile building out at the current level, showing institutions are choosing to transact here, not just passing through. And none of that has happened yet. If we look at the Cantillon flow, it reads accumulation, with the 3-layer breakdown showing liquidity is green, equities are red, risk is red. This is the macro context that ties everything together. The liquidity environment is favorable. The Fed is paused, not tightening, and today's CPI print just gave them more room to cut. But equities have broken their bullish regime after Thursday's sell-off, and risk assets, where Bitcoin lives, are firmly in the red. The macro bonus says 2. That's elevated. It means that macro environment is more supportive of a reversal than the price action suggests. But Bitcoin sits at the end of the Cantillon sequence. For that macro bonus to translate into actual buying pressure in crypto, you first need to see it flow through bonds, which it has, then through equities, which needs to reclaim their AVAB and flip back to bullish, which hasn't happened yet. So the full picture on Bitcoin right now is this. Bearish regime, near maximum confluence at the lows, triple seller exhaustion divergence, 87% coil spring loaded, and a macro environment that is improving but hasn't reached the risk and the end of the chain yet. So that's not a chart that says short into the abyss. It's a chart that says the bear regime is mature, exhaustion is building, but the structural evidence for reversal isn't here yet. The CPI just improved the macro backdrop, but the Cantillon sequence says that improvement reaches bonds first, then gold, then equities, and Bitcoin is last in line. Until the regime flips, and the terminal will tell you the exact moment it does, relief rallies are selling opportunities, not buying opportunities. The 70 to 75,000 zone, if we get there, is where the overhead supply sits and where AVAB is curving through. That's your resistance. The coiled spring at 87 means the resolution is coming. The 3 strong divergences means the setup for reversal is forming. But forming is not confirming, and the Cantillon flow sequence says Bitcoin has to wait its turn. So let's come back to this chart and answer the question properly. Gold is rising because it sits early in the Cantillon flow sequence. It's a hard asset. Central banks, the entities literally closest to the monetary source, they are buying it at record pace. 5,000 metric tons of global demand in 2025. Investment demands up 84%. When liquidity conditions are favorable but uncertain, gold is the first destination for institutional capital. Bitcoin is falling because it sits at the end of the sequence. It requires excess liquidity, money that's already flowed through bonds, through equities, through commodities, to finally reach speculative risk assets. In an environment where the Fed is paused, inflation is sticky, and rate cuts keep getting pushed out, the excess liquidity doesn't exist. Same macro, same Fed. Completely different positions in the flow sequence. Completely different outcomes. That is what I mean when I say regime first, volume second, price last. Most traders look at price and try to predict direction. That's working backwards. The regime tells you which direction institutional money is already flowing. The volume structure tells you where institutions have positions themselves. Price is the last thing to reflect what's already happened beneath the surface. When you understand the regime, you stop asking, is Bitcoin going up or down? And start asking, where does Bitcoin sit in the institutional flow sequence? And does the current regime support a bid? Right now, the answer is no. And it's been no since October. When you understand volume structure, you stop trying to buy the dip in an air pocket with no institutional support and start looking for assets where institutional volume is actually building, like gold of its value area, or defensive equities doing a rotation. Now let's just quick talk about the PMI. And here's where it gets really good. Because while I was preparing this video, the January CPI print just dropped. And the Cantillon framework called the market reaction before it happened. The headline came in at 2.4 year over year. That's below the 2.5% consensus, down from 2.7 in December. The monthly headline was 0.2 versus expected 0.3. Core CPI landed at 2.5% in line with expectations. Shelter, the stickiest component, rose just 0.2, the slowest in years. Energy fell 1.5%. This is the fourth consecutive month CPI come in at or below consensus. Inflation is back to pre-tariff levels, and the market responded immediately. Futures jumped, the market liked it, and the Cantillon framework tells you exactly why, and more importantly, which asset benefited the most. And here we see Bitcoin is really taking a bit now, which is nice to see. A cooler than expected inflation print does one thing in the Cantillon sequence. It moves the liquidity spigot closer to reopening. The Fed has been paused at 3.5 to 3.75%. The strong jobs report earlier this week pushed rate cut expectations back. But this CPI number just pulled them forward again. The market is now repricing the probability of a June cut higher. And when the liquidity outlook improves, the Cantillon sequence tells you where money flows first. It's not to Bitcoin, not to speculative text. First to bonds, and yield dropped immediately. Then to assets closest to the monetary system. Then the assets closest to the monetary source, gold, which had been sold on Thursday's deleveraging, now has the fundamental catalyst to reclaim its bullish structure. And then to equities. And the question becomes whether this CPI print is enough to flip the S&P back above its institutional cost basis. We're only 0.3% below it. So we are very close. And what it does not do, and this is where most traders will get it wrong today, is fix the risk asset regime. Bitcoin at 66,000, now when I'm recording this at 69,000, might bounce on a softer CPI. But a softer CPI doesn't change the fact that Bitcoin sits at the end of the Cantillon sequence, that futures open interest has been cut in half, and that the spot ETFs are in a sustained outflow. A relief rally in a bearish regime is still a bearish regime. The framework doesn't predict its sequences, and the sequence after the CPI print is clear. Bonds first, gold second, defensive equities third, risk assets last. Same order as always. Just as a side note in this Bitcoin analysis, we are above the POC right now, so we want to see that sustained. We still have the real resistance at 75,000 that we need to retake before the regime gets bullish again. So I track this framework every single day across the S&P, the Nasdaq, the gold, the silver, Bitcoin, and Forex, using my AVAP as a regime identification, volume profile analysis, confidence scoring system that I built to quantify institutional positioning. The goal for me, it's not to predict, it's to identify the regime, read the volume, and position myself accordingly. If this framework resonates with how you think about markets, or if it's challenging how you currently think about the markets, I publish a daily institutional volume brief where I walk through every asset on the dashboard using this exact methodology. The link is in the description. Thank you for watching. I'll see you in the next one, and trade safe.